Hi, good morning, everyone. So, share my screen. Okay, so we are going to be going a little bit deeper in today's classes. We are going to be looking at trading with some indicators, right? We're going to be looking at trading with some indicators. There are 1,001 indicators out there. Okay, sorry, we have some people trying to join. Okay, there are 1,001 indicators out there, right? But I'm just going to focus on a few which I believe are very, very helpful. And okay, we still have some people trying to join. Okay, so some of those indicators really are very popular, and the reason they're popular is because they have a lot of usefulness. They are easy to understand, easy to use. So the first one I'm going to go for is I'm going to first of all go for sorry, let me just cancel this. I'm going to go for ADX first of all. So I'm just going to come here and insert the indicator. ADX is average directional movement index. What it does is it tries to tell you what the direction of the trend is and how strong that trend actually is. I repeat, it's trying to tell you the direction of the trend. Is it a bullish trend? Is it a bearish trend? And how strong is that trend? Now, when trading Forex, the best thing you want to do is to follow the trend. You never want to be against the trend. You always, at every point in time, you want to know what is the trend? Am I going in the right direction with the trend? So something like the ADX, I use the default settings, right? Let's just look at it. The period is 14. It's applied to close. And then for the bullish trend, I use green. For the bearish trend, I use red. You can decide to change this as you wish. Then I apply the level of 25. You just come here if you want to add, let me delete this so that I'll just show you how to add it. Put 25 and you add. So it has created that level of 25. And you go to OK. And there you have your ADX. Okay, sorry, let me just respond. Someone is trying to join the meeting. Okay, so there we have the ADX plotted on the graph. Let's go to a higher time frame so that we can see it very clearly. Most of my examples will be made on gold. Like I said, I like gold a lot because of the way gold trends. It's a very trendy pair, and therefore it's very good if you are a trend follower to follow a pair that trends a lot. Now we can see on this chart, we can see the green line clearly depicts a bullish trend. The red line clearly depicts a bearish trend. So anytime that you see that green line trading above, that green line clearly above the red line, it means you're in bullish territory. This is an example from here. You can see the green line crossed above the red line and is now trading above the red line, and you can see that the market had a very nice bullish run. all the way to somewhere around here. And you can see shortly after, the red line crossed above the bullish line, meaning that we are now, the trend has turned to a bearish trend, and you can see that the market came down from here to this point. Shortly after, it crossed back again. The green crossed above the red, meaning that you are now in bullish territory, and you can see it went bullish again. Crossed bearish temporarily, but there was no real bearish momentum here. Crossed back bullish, and you can see that it went up. So basically, looking at this, you can see that ADX is easy to understand, easy to follow. Another thing we want to take a look at, right, is the strength meter. Let me put it like that. Let me call it the strength meter. And that is that white line. You can see that we have the level we included, level 25. You can see that anytime that white line is above that 25 mark, it crossed above the 25 mark here, whatever trend you are in is seen as a very, very, very strong trend. If it is below, you can see all through this area from here all the way to here, it was trading below the 25 mark. We can zoom in a little bit more to see what I'm talking about. You can see this period here. From here all the way to here. From this period all the way to this period, you can see that the market was pretty much sideways. Although you are getting bullish and bearish crosses, you can see that the market was pretty much sideways until the white line crossed above this 25 mark, and you can see that you now had a very strong trend. And you can also see that even when the market crossed bearish here at this point, the 25, okay, my apologies. It seems as if my network connection was interrupted. Okay. Okay, so going back to this, let me just recap what I said earlier. We can see that from this area, from this period to this period, the strength meter was below the 25 mark. And because of that, you can see the market was pretty much sideways. Although it was tending towards the south for a little, it was going down a little, but really there was no strong trend, there was no strong momentum in the market. And you can see that clearly in the ADX. Here to here, it was really trading below 25. But you can see as it went above 25 here, you can see there was a very strong push upwards. A very strong bullish trend as the strength meter got above 25. So from here all the way to here, from this point all the way to this point, you can see that anytime there was either a bullish cross or a bearish cross, it usually came, the trend was usually very good because the signal strength line is telling you it's above 25, telling you that it's a very strong trend. Whether bullish or bearish is a very strong trend. So that is basically ADX. the basics of ADX. Now, there are other things you can factor into ADX, which I'll take in the next course. I think we need to first of all go into moving averages before I take you a little bit deeper into ADX. But basically, that is the fundamental thing about ADX. But the thing about ADX is that it can give you, when you are in a bearish trend, it can give, when you're in a bullish trend, it can give you some bearish signals. So the advanced way to trade it is to trade it with some filters. Like I said, the best filter for that is moving averages, and we'll touch that once we are on moving averages. For those of you that have seen my charts, you would have noticed that you always see ADX on my chart. It's one of the tools that I use to trade. So that is ADX. So the next one we are going to be looking at is MACD. The full meaning of MACD, let me just put it there, is moving average convergence divergence. So you have a set of moving averages in MACD, and you are looking at how they converge and how they diverge. Basically, that is all MACD is all about. Let me remove the ADX and insert MACD. You can have more than one on your chart, but I like to keep it pretty simple, keep the chart as neat as possible so that it won't be so noisy. So MACD falls under the category of oscillators. Yeah, under your indicators. The indicators, basically what they're trying to do is to try and show you the direction of the market, whether it's bullish, whether it's bearish. Basically, that's the job of indicators. And so many indicators, some are, most indicators are lagging. They lag behind the price. That means they wait for the price to act. Once the price has acted, they now tell you, okay, this is what has happened. So a lot of times, indicators are behind the price. That means market has already moved before the indicators will give you an entry. But still, that doesn't mean that you can't still make good use of the indicators. So the indicators are shared into categories. There are indicators that follow the trend. There are indicators that are oscillators. That means they go between a fixed maximum and a fixed minimum. An example is MACD. Another example is stochastic. We'll go into stochastic as well. Another example is RSI. Another example is CCI. Now, you can get more information about these online, but I'll just focus right now on MACD and stochastic. So if you select your MACD using the default settings as well, so this is our MACD, this is what it looks like. You have the histogram and you have your signal line. So basically how MACD works is this. Sorry. So how MACD works is this. The signal line, once it cuts above the histogram, if the histogram cuts below the signal line, you are in a bearish territory. When the histogram cuts above the signal line, you are in bullish territory. Also, when you have a crossover, we also have sorry, let me just add that level 0. Let's add that. You also have this 0 line, right? Because MACD oscillates between the positive region and the negative region. From positive above 0, negative below 0. Now, you can see here that the histogram is trading below the signal line. You can see there was some bearish activity here just for 2 candles. You can see that the histogram here cuts above the signal line, and you can see there was some bullish activity Here, the histogram cut below the signal line, but it actually did not give us any bearish momentum in the market. It traded back above the signal line, went up briefly, and then crashed. You can see another example here. It's trading below the signal line, and that actually led to a very strong bearish trend. So basically, that's the way we use MACD. You can see it cuts above the signal line again, led to a bullish trend in the market. That is the basic use of MACD. Now, there are more advanced uses of MACD, which actually lends to its name, which is the moving average convergence divergence. That means you are looking for a convergence or a divergence in the market. Now, recall we have spoken about support and resistances. Now, if you set we have a resistance somewhere around here. Let me look for another support. Okay, we have support in the market somewhere here. We have another support. We have a support in the market somewhere around here. Now, looking at the behavior of the price relative to the behavior of MACD, you can come here and you can see at this point, market created a high, MACD also created a high. At this point as well, at this point, MACD created another high. Sorry, my screen is misbehaving. There'll be high here. You have another high at this point. Okay, so if we're going to be looking at this, sorry, it should be here. If we're looking at these three sets of highs, right, that was created in the market, you can see there was a corresponding high on MACD. Although this one did not, this particular high in the market did not correspond with the high on MACD, but this one corresponds with the high. This one also corresponds with the high on MACD. But you can see these three highs happened on or around this resistance point. And you can see that the resistance, let me remove this trend line so that they don't confuse us. Okay, you can see that these highs happened around the same point, around the same value at the market. But if you look at the highs as they are depicted in MACD, you can see that MACD is going lower. The high in MACD here is lower, the high of MACD here is lower than the high of MACD here. But the high of the market here is lower than the high of the market here. So you can see price between those 2 points, price went up. But between these 2 points, price went down. I mean, sorry, MACD went down. This is when you have a divergence. You can see this point is going up, this point is going down. Based on the expectation for MACD divergence, it means that price will follow the direction of MACD, meaning that we're expecting gold to drop in the next few days. This is based on MACD alone. Now we can still look for more examples of convergence and divergence on MACD. Let me look for a good example of convergence. No, divergence, that means price is moving away from MACD. but in convergence, it's coming together. Look for a good example for you guys for here's another example. This is a support in the market. You can see price created a low, another low here. But while creating all these lows, MACD was busy creating highs. Market was creating lower lows, MACD was creating higher highs. And you can see that that led to price going higher. This is an example of convergence. You can see the MACD is coming towards the price. That means MACD is going up, the price is flat, MACD is going up. So you have a convergence. In the case of a divergence, MACD is moving away from the price. You can see price is going up, MACD is coming down. MACD is moving away from the price. That is the divergence, that is the convergence. There's also what is called hidden divergence, although I won't go into that at the moment. Next thing we're going to be looking at, okay, like I said, we have stochastic. Let me insert stochastic here. Stochastic is also an oscillator. We'll use the default settings as well as on oscillator stochastic. We are going to add 2 levels to our stochastic, just as we did for MACD and for ADX. You just go here and you add. The levels we'll be adding is 80 and 20. Stochastic oscillates between 100 and 0. Those are the values it oscillates between. ADX also oscillates between 0 and 100. MACD oscillates between positive and negative, above 0 and below 0. That's just something you need to take note of. So these are stochastic plotted on the graph, on the chart rather. Now we can see that anytime the stochastic goes above the value of 80. Okay, let me just give a brief history of stochastic. Stochastic now measures when a market is overbought or oversold. When a market goes, when it's buying, there's a strong bullish trend. It gets to a point where even though the bullish trend is still the bullish trend is still on, but it gets to a point where people are bought. There's that exhaustion in the buying pressure, and then people begin to sell off a bit. It's called the overbought. The market is now overbought. It has to come down a little bit before it starts buying again. That is why even if you're looking at the trend of the market, it doesn't go in one direction. You can see from here to here, the market was bullish. But you can see it did so in waves. It was going up, it will come down a bit, up, it will come down a bit, up, come down, like that. It moves in waves. And even if it's coming down as well, it also comes down in waves. It doesn't come down in one direction. So those waves is what MACD is trying to capture, right? Whenever the market is overbought or the market is oversold. So whenever the stochastic gets into the 80, between 80 and 100, it is said that the market is overbought. Whenever stochastic is below, whenever stochastic is between 20 and 0, it is assumed that the market is oversold. So if we just follow this on the 4-hour chart for gold, we can see from here that the market is overbought. But it's still going up. When it's overbought, doesn't actually mean that it's going to sell immediately. But we can see once market comes out of that overbought zone, somewhere around here, you can see that it led to the market coming down. There was a over 600 pip drop in the market. You can see here that market is in the oversold zone, entered oversold here, exited the oversold zone around here. Although market still dropped for a while, but it ended up buying again all the way to this zone. Here again, we have it, market is in the overbought zone. Coming out of the overbought zone, you can see that the market came down another like 500 pips or so. You can see market here again is in the oversold zone. Coming out of the oversold zone, you can see that market rallied for about 600 or thereabout pips. So you can see the stochastic tries to catch the wave of the market. If it's overbought and wants to sell, stochastic shows that. If it's oversold and wants to buy, stochastic captures that. Let's see another good example of over. Okay, here we have market is overbought. There are some times that it just gets to the over, it just touches it, but doesn't really go into the overbought or oversold zone. In such scenarios, I tend to ignore it. This is another example of it just kissing the overbought zone. It came down briefly, but market ultimately continued to buy. So that is stochastic. Another way of trading stochastic is by looking at it from dual time zones and also adding another filter. Because if the market is in a general uptrend, stochastic will still give you overbought scenarios, meaning that you are expecting the market to sell. But if you have a filter, that means something that tells you that, okay, the market is buying, we're in a bullish trend. Maybe you have your ADX with you. ADX is telling you that this is a buy trend, a buy market, and the trend is very strong. ADX is already telling you that you might want to only take oversold conditions. You know, oversold conditions is telling you that the market wants to buy. And you have a filter that is telling you that the market is bullish. So in that case, you might not want so much to sell. You might, when you see overbought conditions, you won't really want to sell because something is telling you, you have a filter that is telling you that the market is overall bullish. So you are going to be looking out for, oversold conditions so that you can buy. So we'll still get to those filters when we start talking about moving averages, right? When we start talking about moving averages a little bit more, we'll be able to get into that. So we've looked at ADX, we've looked at moving averages. Another one, we've looked at MACD. Another one that I want us to look at is Ichimoku. It's a Japanese word, and it's originated several years ago. And really, if I'm going to go into how there's so many different terminologies and so many different areas and aspects of Ichimoku, which I might not want to go into in depth. You might want to read up on it, but I'll just show you basically how to use it. Okay, what I'll be teaching you guys is how to use it. I won't teach you the history and whatever about it. So in Ichimoku, you have the Tekkan Sen, you have the Kiju Sen, and you have the Senku span. We are going to be using the default colors. We're going to be using the default colors. So when you just put that, plot that on your graph. Sorry, let me change this. Okay. I think I need to change the colors of this so that it will be a little bit more visible. Let me change this to white. Change this also to white. Okay. So this area that you are looking at that is whitish in color is what is called the Ichimoku cloud, because it's fuzzy, it looks like a cloud. And let me zoom out so that you get a better picture of it. You can see it looks like a cloud. And that Ichimoku cloud, right? It is assumed that whenever price is trading below the cloud, you are in a downtrend. Whenever price is trading above the cloud, you are in an uptrend. And whenever price is within the cloud, you are expected to step aside. Now looking at, let me zoom back in so that we can look at the trade entries. And you can see quite clearly, let me start from here. Market is trading above, this is a cloud right here. Market has closed above the cloud, and you can see that there was a strong bullish run. If you come here, you can see market closed below the cloud, although that did not end up in a bullish run. Like I said, no indicator is 100% accurate. No indicator will give you 100% entries. So in this particular place, it would have been a failed entry. Ichimoku is something I used for a while and I really loved it. And it's actually quite, its level of accuracy is quite high, especially for trending pairs, like I said, gold, crude oil, and most GBP pairs. But it operates similarly to moving averages as well. So I opted to go with moving averages instead. But that still doesn't mean that Ichimoku isn't a very powerful tool. Something about Ichimoku is that it makes your chart very messy. There are so many components to it. And when you plot it on your chart, sometimes you don't even know where your candles are. You don't know where the cloud and all the different things just makes it very, very messy. So at this point, you can see that the markets price closed above the cloud. This led to a bullish move. You can see again here that price closed below the cloud, resulting in a very strong bearish move. You can see here, price closed above the cloud, leading to a bullish move. And then, okay, there's something here, rejection of the cloud, right? Let me just touch on that. Anytime you see price coming back to the cloud, and instead of going through the cloud and maybe ending up in an opposite direction, giving you a opposite signal, here it was buying. and then it came to the cloud, but there's rejection on the cloud. You can see it got to the cloud, and the cloud itself acted as a support to the market. You can see that also led to another bullish run. If we come back here again, you can see that the market came down, 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 got to the cloud. The cloud acted as a support to the market again, leading to another bullish run, right? You can see here, the price closed below the cloud, leading to a bearish run. Came back to the cloud and found support in the cloud. The cloud acted as a resistance, sorry, to the market. Just the same way it acted as a support here, acted as a resistance. You can see another bearish run. You can see a bullish close here, but this bullish close didn't really, there wasn't really that much of a bullish momentum here. But it came here and found support in the cloud again and closed bullish, and that led to another bullish run. Presently now, the price is inside the cloud, so you take no decision. If the cloud acts as a support to the market, it will be another opportunity to buy. We can see that from this cloud, from this example I've given you of the cloud, of the Ichimoku, you can see that we had about maybe 8, 9, 10 trade calls from this, and only 2 or 3 of them, or basically only 2 of them failed to materialize in actual trades, which actually shows you how accurate and how effective Ichimoku itself is. It is very accurate if you know how to read it. And it's actually very simple to read. And you can even still go ahead and how will I say, Ichimoku itself can give you filters. A way it can give you a filter, right, is when you are looking at it from multiple time frames. You know, I had spoken earlier that for you to be able to trade effectively, you need multiple time frames. Okay, let me see if I can quickly squeeze that in, right? You can see that on a higher time frame, let me remove these lines quickly. Okay, you can see on a higher time frame, which is daily, you can see that Ichimoku, right, closed bullish on the daily time frame, on daily time frame on this candle. So if you come to lower time frames, like 4 hours, you're only going to be looking for bullish trades. If you see a bearish trade, you ignore it. That is the filter. Because on the higher time frame gives you the longer term trend of the market. That means overall direction of the market. And on daily, it has shown us that what the trend is bullish. So any other time frame below daily, you would actually ignore any bearish trend until daily becomes bearish. If the daily candle becomes bearish, then on lower time frames, you also look for bearish signals. But for now, daily is still trading above the cloud. Therefore, if we come to something like 4 hours, you can see that anytime it closed bullish, we had very good trades. Here it closed bearish. There was a good trade here, but I would still ignore that. We can even see that there was a slight rejection of the cloud here. Gave us over 100 pips. Another bearish trade here, which I would have ignored. Then we can see there was another strong bullish trade here. Like I said, currently market is in the cloud. the price is in the cloud, so you are going to ignore that. If it closes bullish, since daily is already bullish, you might want to actually join that. Let's go to 1 hour and see what we can see from 1 hour. Remember that our daily is already bullish. Let's go back to where daily turned bullish. I need to scroll